But my mama didn't raise a fool. And if she did, it was one of my brothers. And what you're doing, you know it and I know it. And all those people sitting behind you know it. You're paying 5% to borrow money when you could pay 4% to borrow money. You announced you were going to do that back in November 2023. You're working cross purposes with Jay Powell, who's trying.
We're not working.
And the reason you're doing this, is try to give the economy a sugar high 5 months before an election. Now, you know that, and I know that.
There's nothing about issuing short-term debt that creates a sugar high for the economy.
My chairman says I'm out of time.
1 year ago, I did a video on how the Trump administration was going to continue policies to manipulate interest rates lower. What I didn't realize at the time was some of the tactics they would use and just how subtle they would be. Not only that, but we can now see in data the impact it's having on the housing market. There is some direct correlation between the timing of some of their manipulation and what happened in the housing market. I'm going to show you a chart shortly that will blow your mind. It may not feel like they're manipulating interest rates lower because mortgage rates are in the sixes and that just feels very high from where they were in 21 and 22. But believe it or not, mortgage rates have dropped a half a point since last year, in spite of a hotter jobs report this week, in spite of an oil shock in Iran. Food costs are rising at the fastest pace in 3 years, and the national U.S. debt just topped 100% of GDP. All of this has analysts expecting interest rates to rise.
You guys were talking in the previous segment about earnings, about the stock market. We had a decent payroll report today. The economy's doing well. We're just creating more inflation. And if you're creating more inflation with the economy doing well, then the path for yields, bond yields, is going to be higher.
I really do think that the new Fed chairman's inflation-fighting resolve will be tested by financial markets, and I think the Fed has been a little too dovish.
So why did mortgage rates drop on Friday after a hot jobs report, after all of these inflation warnings? Why are mortgage rates dropping at all? Shouldn't they be going up? Well, there was another announcement this week that didn't get nearly as much attention. On May 6th, the U.S. government announced that they were going to continue with the policy of issuing extra debt on short duration bills. Now, this is important, and there's two key things you need to know about this that absolutely impact mortgage rates. The first is that the interest rate right now on T-bills is 3.7%. This is down from 5.5% in 2024. But the second is that the buyer for these treasury bills happens to be the Federal Reserve. That's right. The U.S. government has begun monetizing debt. Now, they don't want to call this quantitative easing, but that's exactly what it is. So think about it this way. The interest cost of short-term debt is dropping dramatically over the past 2 years. At the same time, the Federal Reserve is buying it. This is reducing the debt burden of the U.S. government dramatically. Now, on top of this, last June, Fannie Mae and Freddie Mac started quietly building their bond portfolio of mortgage-backed securities. This put downward pressure on mortgage rates. That's when we started seeing a shift in the housing market. Last May in Nashville, we had 2,100 more active listings than the year before. It continued through June, but then something changed that nobody could really explain. Active listing growth just stopped in its tracks and started going the other direction. Now, at the time, nobody had any idea that Fannie Mae and Freddie Mac had quietly started buying mortgage bonds, but it's clear that whatever they were doing was starting to tip the housing market in a different direction it was going. Now, something had changed in the housing market, and that change was market manipulation. We are now only 569 active listings higher than we were last year. And nationally, inventory is starting to shrink by some metrics, including Redfin.
Did you think we would have fewer homes for sale right now than this time last year? I didn't at all. No, I had no idea this would happen.
Single-family pending contracts are up 14% year over year and higher both in 2025 and 2024. Price cuts have even stopped increasing. This is a little bit of a surprise, as last year at this time, they were accelerating higher. This year, they've stopped in their tracks. And even new builds have been in a lull for years and now starting to break out to the upside. This to me is another indication that Nashville is having another wave of migration. And this housing market quote unquote recovery that we're seeing, this manipulation, it's very, very K-shaped. CNBC just covered this, that wages on the higher end are actually accelerating higher while the lowest are struggling. This is not good for the housing market.
Report comes from actual bank account data. It found wage gains of 6% year on year for the highest income groups, 1.5% for the lowest. B of A economist David Michael Tinsley, he doesn't know why this is happening. He could be related to bigger bonuses that are out there. Automation, he said, could be undercutting the bargaining power of workers at the bottom end of the wage spectrum.
Now, this K-shape is dramatically impacting the housing market. This is why some people feel like the housing market is crashing while others are seeing it just continue to go up and up and up. It has completely divided. The $2 million price bands in Nashville are now up 72% from where they were just a year ago. Unbelievable. But the higher up you go, the more demand increase there is year over year. And the lower you go, under 300 is basically flat. In fact, I would say the under 300 are primed for a crash. These are your townhouses. A lot of townhouses actually are crashing and have been crashing for the past 24 months. Here's a perfect example in Green Hills. What we can see is this neighborhood has been up 3% year over year when we look at median price per square foot. However, if we were to zoom in on the smallest attached townhouses and condos there are, what we'll see is there's a clear downtrend that's been happening for the past 2-3 years. Again, you can see it when you look at sales price. There's some now going for $175,000, something unheard of in 2020, 2021. Now, if you are a buyer in this market, I am finding a significant ability to negotiate on price. In fact, we just negotiated this week down, and this is rare, but we negotiated almost a 10% reduction in list price on a property that had just reduced their price. In other words, they reduced their price, and then we asked for an additional, got almost 10% off of the list price. If you are negotiating and there are no buyers for a property, you should be asking aggressively. And really, expectations wise, I think 3%. If it's not under contract and they don't have any other offers, you should be getting at least 3% on the property, whether that's in form of concessions or sales price reduction or both. That being said, I am seeing and experiencing in multiple contracts a reduction much further than that right now. Now, how long this will last, I do not know, but it is a great time to be aggressive on offers. I hope you find this information helpful. I hope it sheds a little bit of light on the manipulation around the market and why, as a housing analyst, it's almost impossible to predict the future, although I can tell you what's happening right now, currently. And with that, I hope you all have a great rest of the day. I look forward to seeing you next Saturday. Thanks for watching.